Hello, my name's Angel. This is my second video for for Finance 335, which is financial modeling. So just beginning off with the financial techniques that I have learned so far, which is just going off chapter one. We have relative and absolute referencing or cell referencing. We also have just the spreadsheet model structure, the basics of Excel formulas, financial formatting, as well as just copying down formulas. Um, Again, and I just want to kind of say that the titles that I have given, the things aren't exactly from the book, but it is kind of just what we have learned. Going on to chapter two, we did growth rate calculations, percentage change modeling. Chapter three, some common size analysis, as well as a lot of financial ratio calculations and horizontal analysis. Chapter four, cash budgeting modeling, the operating cash flow forecasting, the linked financial statements, and some time-based financial projections. And then moving on to chapter five, we had the pro forma income statement model, as well as the balance sheet model, the percentage of sales forecasting, regression analysis, and in the end, financial forecasting models. Chapter seven, we did have scenario analysis, the scenario manager, and just model output visualization. So the three that I ended up picking were cash budgeting or the cash budget model technique, as well as the pro forma income statement model and the scenario analysis. So just starting off, I wanted to start off with the cash budget model. Just kind of go over a little bit over this. So the whole formula and sheet as it is. So we obviously see everything's already set up. This is just taken from the exhibit from the homework that we did or that I did. Um, and this was also the I believe when we learned about this formula right here, which connects down to this down here, which again just changes the month and creates an actual formula instead of just writing down May, June, July, and so forth. So right here we have June. Obviously, here we have we're taking May and we're adding a month or 1 month to it, which is June. If we were to do two, we see that it all changes as it all is linked together. We now have July through October instead of June. And here again, it changes from for the period of July to October. So let's just go ahead and change that back to the one. So here we have all the stuff. Everything is correctly working. As I'm just going to demonstrate what the cash budget model is. So in this case, I will just be going to change this from 400 or 387,000 to 450,000. 450,000, and we see that there are some couple of changes. We see that our cash went up to up to 180 or 180,000. We also see that our total collection goes up to 387,900. Our wages goes up as well, up to 90,000. Our total disbursements, of course, goes up, and our current borrowing, we see goes down, which is amazing as we always want to borrow the least amount possible, of course. Borrowing less is obviously better in any form, in any case. And here we're just showing how cash budget just helps us forecast liquidity. So here we have the sec all the months from June, July, August, September, and then we have the prior months, which is these are no longer assumptions, of course. These are in this case the sales that actually happened. So sales for April, 290,000. For May, 365,000, and if we were to do the period of June to September, the assumption was that, or the original assumption was that we would get 387,000 cells. Um, and I ended up changing that to 450,000 here. So this is the new input for June, which we see how all the formulas change and how they work, and they don't give me any problems further on. For this, I think the main struggle with me was to remembering to always reference down here these percentages right here, just referencing those and also how the months work. So we go from May being the first month and April being the second month. So we're reading from right to left in this case instead of the usual left to right. And that's kind of just a simple, but I think this is obviously super important. And I think this is I chose this simply because I think cash budgets are important when dealing with the company, and I think they are done a lot. I mean, this is obviously changed each month. Each month, you obviously had the assumption, and then the next month that you do, um, you now have the actual sales amount. So let's say we were to do in July, and let's end up pretending like this actually is 387. This actually ended up being 387,000. Well, then now we know that we can now we now see what is true for the month of June. So all this is true, and obviously this changes each month as each month. Um, Maybe in August, we originally assumed we were going to sell 329,000. We actually undersold, or we actually sold more than this, and that's kind of why I decided to include this into the modeling technique and just kind of demonstrating it a little bit. Just moving on to the pro forma income statement. Um, so again, this is just forecasting. Again, forecasting, I think, is I like to do. In this case, we're forecasting for 2021. So in this again is just super simple, something super simple, I think. Um, and just very effective at the same time though, because it is easy to kind of forget about how to properly do this, the pro forma income statement. So to get the sales, we're assuming we're going to get 4,300,000. In order to get the cost of goods sold, we get the and when forecasting we have to get the average. So we have 3.2 uh, or I guess I'll just say 3,250,000 divided by the 380, 850,000 divided by the average, or divided by these two over here, the same equation. We get that average, and then we ended up multiplying just like normal to the sales, which we end up getting 3,609,000. We see that our growth profit goes up here. And it's kind of something that I just wanted to show is obviously the tax rate. So the tax rate that we're forecasting here, um, we're assuming in this model from the exhibit from the homework, we're assuming that the 25% from 2020 carries over to 2021. However, this is not the case well, in real life, sometimes this is not the case, as sometimes a lot of tax rates go up, they go down, they change a little bit. But yeah, in any case, if we were to change it from 20%, we see that we go from 113,000, uh, or income goes from 113 to 121, which is amazing. Obviously, this is this is good because our net income goes up. Now, if we were to go from 20% or from 25% to 30%, we do see that our net income goes down. It is still higher than 2020 as we have a big sales increase. I mean, we're going from 3,850,000 to 4.3 million. So that is around 400,000 of an increase, um, or 450,000 of an increase. Again, that is huge. So that kind of does or shows why our net income is almost double, or it is basically double, or almost double. But for doubled from 2020. But if we were to compare it from 2019, we do see that it actually is lower. But that again, that is because we do not have the tax for this one as well. But if we were to put the tax in, we obviously see there would be a huge difference. Let's say the 2019 was also 25%. This doesn't change, but we now change this um, to the we would change this to 25%. We would multiply by 25%, which would give us the other number. But I'm just doing 2021 because that's what we have. This is already set in place. Um, But here we do see that the tax rate is 3%. So changing tax rate assumption, uh, in this case, this model that I built, Excel will automatically update our taxes and the income. And it's obviously useful for financial statements. Moving on to our scenario analysis. which is this case or this exhibit again. Um, for this exhibit, we now have a minimum acceptable cash, so we have to have at least $15,000 um, in the form of cash. Here we do see that our maximum borrowing, if we would do if we were to put $200,000 in capital outlays for the month of July, our maximum for this is 105,000, and this is just the maximum borrowing is just the largest amount. Um, the company can borrow from the bank during this period in order to maintain the minimum cash, which is 15,000 for this model. And of course, lower borrowing means which is better. I mean, it usually means less interest and less risk financial wise. Um, but here we are talking about the expenditures. So the timing of when we buy uh, expenditures or when we purchase different expenditures will change the amount that a company actually needs. So here we do have 200,000 in July. Now, if we were to change this to June, we do have we got to change this to zero. This is doing it manually, which does potentially can create errors. But here we do see if we were to invest or buy expenditures in June. Our borrowing goes up to 213,000, almost $214,000 dollars, which is not what we want. So we do not want to go ahead, and it'd be better if we did not buy in June. Um, Now, if we were to go down to, let's say, our change in expenditures happens in August, well, now we do see that our borrowing is now $13,800. And the same thing would go for this. We go down to 200,000. And we now change this to zero. We do see that it also stays 13,800. And this is simply because you have more time to generate the money compared to if you were to do it in June. Um, which is you would need a lot more, you would need to borrow a lot more money from the bank. So just showcasing it and going back to zero, now doing the actual scenario manager which is, I guess, the easiest method of doing this. So simply we go to Board of Analysis, Scenario Manager, and I did already have it set up, but basically what you want to do for each one is you create the scenario for June. We do see that it automatically updates what we did manually. So instead of doing manually, this updates it for us, which leads to less risk of of creating an error within the sheet and forgetting about it. So we do see for the June, 213,000, same thing. Now we show July, same thing as doing it manually. Again, it's just faster and I think a lot simpler. August, boom, 13,800. And then boom, we also have 13,800. So let me switch it back to July. And then if you want to do this, if you want to see all four of them, you know, you don't have to constantly change. You want to showcase this to somebody, you simply click the summary, you create a scenario summary. The result sales is 105,000. And here we have expenditure in June, 200,000. We see that's $213,800. In July, it's 105. In August and September, it's 13,800. And this is kind of just the scenario summary or the scenario, yeah, the scenario summary and using scenario manager for this model.